Hello, mortgage broker. Hello, mortgage broker community. I got a special guest here today for an interview to keep us up to date on what's going on in the market. Obviously, it's on the top of everybody's mind. I have Logan Mohtashami, who is a expert contributor for HousingWire.com, is a housing analyst, and has been featured on Bloomberg and many financial networks, speaking on the housing economy and also speaking on the state of the market. So Logan, thank you very much for taking the time to talk to this community today.
My pleasure.
So Logan, obviously you're kind of a hybrid here, because you know loan origination from an LO's perspective, and you also are an expert on the market. So, talk to loan originators right now. They're all in a kind of a state of frantic panic because they got all this business, but rates are the rates are down, but they don't think rates are down as much as Treasuries would indicate they would be down. So, what do you say to them?
Well, the speed and velocity of the 10-year yield moving down has been historic in nature. We've had times in this record-breaking expansion where the 10-year yield gets to about 160, and then it kind of trends down a little bit lower due to some headlines. But we've never had it break to this level down I think we got to 0.31% on the 10-year yield on Monday morning. To me, that is a recessionary rate or a recessionary yield. But the velocity of the downturn was so fast that there's no way that rates would ever be able to catch up to that. It's so different now than what it used to be. Let's say in 2003 and 2008, there was prepays back then. It was a much bigger banking system compared to what it is now in terms of a size. So the velocity just can't be captured yet. And until things stabilize, we're probably not going to get the most accurate pricing out here based on where the 10-year yield is today, 0.70 basis points. So I just think that the speed of the news between the virus and then the oil shock in terms of the war that was created between Saudi Arabia and Russia, that's just way too fast.
So you said the R word, and that's obviously, we have the coronavirus out there, but setting coronavirus aside, are we going into a recession? Where do we stand?
Here's the interesting aspect. The economic data actually was getting much better the last 6 months of 2019. And manufacturing data, retail sales, housing starts, new home sales, existing home sales, leading economic indicators, even the jobs data, the 3-month moving average was about 243,000. I mean, that's one of the best 3-month moving averages we've had in the last 4 years. So pre-coronavirus data was actually really good. I think there was a lot of recessionary people toward the end of 2019 that missed it again. But what we have right now is we're going to have 6 months probably of weak data. And then after that, unless the virus gets much worse, the economy should just go back to its slow and steady pace like it's been doing. It was this longest economic expansion ever recorded in history, the longest job expansion ever recorded in history. But right now, we're going to have a 6-month slow patch, and we just don't know the velocity of how much damage we're going to take, because we're not sure, are we going to get containment policies here in America? How much stimulus is the government really going to give? So it's kind of a moving target. I don't use the recession word until my 6 recessionary red flags are up. It's a model that I've used that when I back tested going back to 1960, it's been forecasted every single recession. So only 3 of my 6 recession flags are up. But over the next 6 months, 2 of my recession red flags can rise just because of the damage that this virus has done, not only domestically, but around the world.
How do you think the coronavirus impacts the purchase market this year? Because, I talked to somebody the other day, and they kind of gave me the inclination that they believe that purchase is going to be really, really weak as a result of the virus. And I'm not currently seeing that. Obviously, refi volume is swelling, but that's not at the expense of purchase volume.
The purchase application data, which just came out today, 7 straight weeks of double-digit growth.
Yeah.
Cycle highs in demand. Right now, it hasn't looked this good in terms of the rate of growth on a year-over-year basis since 2016. So 2016 was the last time that the 10-year yield got down to a low level where mortgage rates were, 3.25, 3.5. So as of now, the purchase market is actually looking very good. It still looks to me like another 6 million of total home sales, existing and new home sales put together. The one thing that in the future that might stunt the growth a little bit is that if there's containment policies, and I think that's an important thing, certain people are just not going to go and buy homes. Yeah. But the fundamentals of the housing market is shown basically in the front line of the mortgage purchase application data. We've only had a few times in this cycle where we've had 7 straight double-digit year-over-year growth prints, and this is one of them. Just today was another 12% year-over-year. So as of now, it just looks like to me it's going to be another 6 million total home sales a year. But like everything else in the economy, we just don't know what's going to happen over the next 6 months. And I always say that give this until September. By September, the world has probably defeated this virus to a degree. The news should get better, so you get a little bit more clarity. But for the next few months, we just don't know how the consumer is going to act or what can the consumer do. And I think that's one of the reasons why the 10-year yield has dropped so much out here. And I mean, 2 weeks ago on bankrate.com, I talked about, the 10-year yield could get below 1% if these headlines get worse. Okay, so that happened. Last week, I talked about, well, you know what? Negative 21 basis points to 62 basis points on the 10-year yield. That's my recessionary yields. That's what I would be looking for if I thought we were going into a recession. After the news of Saudi Arabia and Russia, boy, the 10-year yield just collapsed out here. And we had a 44 basis point increase from the lows of yesterday toward the end of the day. And we just got up to about 72, 73 basis points. I mean, in the history of the bond market, that's going to be one of the things I'm going to remember the most about this cycle. So we're going to have to see how the bond market reacts from here, because right now to me it's forecasting a recession. If the news gets better, if once the coronavirus is the infection rate peaks and everything, we'll see how much the economy recovers, because the economy itself is fine. But if people don't want to go out or people not allowed to go out, that's a different equation. So there's certain sectors of the economy that are getting hit. Conventions are all being canceled. Airline flights are being canceled. Travel plans are being canceled. But outside of that, everything is okay. But you're going to get manufacturing to get hit. World growth is going to slow down. But if people start cocooning at home and not eating out or not going to events, stuff like that, it will stunt our growth for the next, I would say, 6 months. And then after that, I think we just get back to the slow and steady trend. That's the difference between this and any other event. Because if it was a normal recession, we have an over-leveraged cycle, there's things that we need to work out with. But this is such a short-term event. When the news gets better and people get more confident, I think you just go back to what the pre-coronavirus stage was, and all that economic data was good. You don't even have to be an economist to read that the last 6 months of 2019, the data got better. Retail sales rate of growth got better. Housing starts were at cycle highs. Permits were at cycle highs. Even the manufacturing data, or the regional manufacturing data, was getting better. So I think you're going to have a rough patch for about 6 months, and then we have to deal with that. But housing, out of all the sectors, as long as people are working and going out there, should be another 6 million total home sale a year.
If we see Treasuries continue to go down, or even like you just mentioned, potentially go negative, how does that impact mortgage rates?
Mortgage rates should be 2.75% right now, the 30-year fixed. And this is something I've talked about for some time. It's been very hard to convince people that we were going to have a 2-handle on mortgage rates.
Yeah.
But it's very consistent with all my bond market forecasts for the last 5 years. The 10-year yield is going to be between 1.60 and 3%. When growth slows down, I think that's the key. Growth slows down, the 10-year yield gets about 1.6, and then these headlines happen. But when a recession happens, the 10-year yield should be under 1%. It's something actually I talked about last year that I thought could happen last year, but it didn't. This year, everything looks normal to me. It's just the reason that we're here is something that's very short term, about 3 to 6 months. That story can change. So does the market catch up to where mortgage rates are? Now you have there's no more prepay penalties anymore in banking. There's EPO risk for these banks. There's capacity issues for this bank, and the speed is just too fast. But if the 10-year yield just hangs around here, the pricing actually should get a little bit better when things start to normalize out here. But when you take that much demand, if you look at the refinance index, it just went straight parabolic from last week. It went all the way up to the 2012 levels. To me, that was the last real refinance boom we had.
Right.
So there's just way too much demand coming in a short term.
Yeah, and I think, the dynamic that a lot of originators are missing is, for if the coupon, if 2.75 opens up, rates were really good in 2019. In the second half of 2019, rates were great. If 2.75 were to open up, which is right now, the expectation is some wholesale lenders are going to be opening up to brokers, is if that were to happen, anything that a lender did a loan on in the last, ever, but like is in their servicing book most recently, opens up to a refi. And I think the lenders are, kind of holding back because they don't want to create their own runoff.
I remember in 2012, there were certain lenders that needed 120 to 150 days to close.
Yeah, I remember that actually.
And that didn't leave a good taste in anybody's mouth, and there's issues with that. I think some lenders have figured it out. They don't want to do that again. 2.75%, you get these refinance indexes to look like 2003 and 2008-9. So there's actually so much more upside potential in terms of a business because you capture everyone out here. So the supply was slowly coming off the marketplace, but once the 10-year yield broke really under 120, it opened up the floodgates for everyone. Now, not everyone the mortgage rate should be lower, but it's not there. If it was, it would be way too much business in a very short time. Just do not have the capacity to do that at this level. And this is why we see the pricing not working out as someone would have hoped.
So let's just hypothetically say this is, you had mentioned 6 months as a number for the, for how long this goes. Let's hypothetically say that goes that way. What does the market look like? What does the mortgage market, the housing market look like post a 6-month run or 8-month run at these interest rates? Meaning, if everybody's at 2.75, 2.875, 3.125, how does that change consumer behavior when it comes to home buying, selling, everything? I mean, I would imagine that's going to have an impact.
Mortgage rates have ranged between 3.25% to 5%. Existing home sales have been roughly flat, kind of for many years. The only time that housing ever gets hit is when the 10-year yield is above 2.62%. We saw that in 2013, 2014. We saw that in 2018 to 2019. So to me, the only thing that changes the narrative is when the 10-year yield is higher. Now, if growth picks up and we see the data, the bond market is going to get ahead of that. The 10-year yield should get back up to about 133 to 150, around that level. Once the data starts to get better, the bond market will get ahead of that. But housing was fine with 4.25, 3.75. The velocity of housing really getting overheated is just not going to be the case. Mostly it's because people are staying in their homes longer.
Yeah.
But anytime rates are lower, you see this impact to where it just solidifies a stronger market. And the demographics for housing, actually, this is the period in time where the demographics for housing actually get good. Ages 26 to 32 are the biggest in the history of America. The first-time home buyer age is about 33. The first-time homeowner, that if they do need to move up, is in the best financial shape compared to what it was in the last 2 decades. There's a lot of nested equity. So if they needed to move, they could move up. So my concern actually is that when the economy gets track and if rates are low, real home price growth will start to pick up again. Adjusting to inflation, the equivalence of rent, real home prices actually went negative last year. I thought that was really bullish for housing.
Yeah.
That real home prices went negative. That means that we're not an overheating housing market. This is not record-breaking demand, just very slow and steady. So I kind of look at it as total home sales, existing and new, should be about 6 million and should stay there for some time until the 10-year yield gets above 2.62%. So just think about the solid base demand always going to be here as long as rates are low. But don't think of 2002 to 2005, where existing home sales got up to as high as 7.26 million, or the purchase application index got up to about a 500 on that data line. So that solid base should be here. We have a lot of replacement home buyers coming into the market as long as rates are low.
So we have, AIM has over 40,000 originators as members. What advice would you give them to give their customers that are saying, hey, should I wait to refi? Should I refi now? I know you and I will, when I talk to people, it's always, well, if there's a benefit right now and you can get a lower rate and the savings are there, capture it. But a lot of consumers and a lot of loan officers are saying, well, eventually the Treasuries, rates will catch up to Treasuries and we'll see lower rates. So what would you tell somebody?
Always have a game plan with each client. Get ahead of the 10-year yield movement. Talk to them before yields go down. So when it does happen, you can get it into the system and lock them, right away. And I think getting ahead of the 10-year yield and mortgage rates with each specific client, because each client has a different kind of situation, that's to me, that would be my best advice. Because if the 10-year yield doesn't go down or mortgage rates, it's irrelevant. Nothing's going to happen. But if you get ahead of the data or ahead of the movement, there's a better situation to actually get it closed or get the rate locked or get the process going out here. So get ahead of everything with each individual client you have out there, because in this kind of market, it's just the pricing is so wild, because people would assume that the rate should be better and it's not. You got to explain to them why. But if you have a game plan for each client, then at least they know where they stand at, and you know where they stand at with each one. And then when it happens, boom, you got to go for it right there. And then I think that's the best preparation any loan officers could do.
So I got two more questions for you. One, what pressure are the people running capital markets at lenders and banks feeling right now? What have the last 2 weeks been like for these individuals?
I just think with the coronavirus in play, there's so much uncertainty that people are probably too confused to really worry about it too much, because they don't know. I mean, I've never had so many questions about, is this going to crash the economy? Is this a recession in the last, I would say, 5 days than any other period in this record-breaking expansion out here. And it makes sense, because this is a virus. This isn't something that's, this isn't like, higher interest rates or Fed rate hikes. Everything else that was supposed to create a recession in the last 11 years have failed. But this is the one thing, on February 3rd on Housing Wire, I said, I gave this event the chaos theory, the butterfly effect. This is the one thing that has the ability to touch everyone, because we just don't know. And that was back on February 3rd. And we can see this every other day. Some other country has cases, some other country is doing, we just don't know. So the capital markets, everyone is just kind of confused on how to think about this, but the bond market is just blowing through some levels that to me if the bond market is saying we're going into a recession, as long as the 10-year yield is below 62 basis points, I'll stick to my model all the time. The bond market is saying it's going into recession. It's higher than that now, but this thing can change on a dime, and I think that people have to be mindful of that. Once the virus news starts to dissipate, once people start going back to work, like one thing I talked about on Housing Wire, China's trying to get everyone back to work as soon as possible. If you have a second wave of infections coming out there, that's something that could draw the 10-year yield down and bring mortgage rates down, because we're now dealing with all this velocity of information and business. But if China could get back online, and South Korea could get back online, and Italy's rate has peaked, and we're going to have our infection rates increase. But once that is over, the bond market will start to say, hey, listen, it's not that bad, so the 10-year yield should rise. So the capital markets are just confused on when's that going to happen.
So let's just make a hypothetical. Coronavirus goes away, you anticipate by September, we get through the election cycle, all indicators in the market continue back to where they were prior to this occurring. Where is the 10-year Treasury next year, end of next year?
160. The 10-year, the 10-year to me, this goes with all my forecasts every year for the past 5 years. The 10-year yield should be in a range between 3% and 160. So a slower rate of growth brings us to 160. In 2012, 2016, and 2019, the 10-year yield broke under 160 because of events. The European bond market scare in 2012, 2016, the Brett exit scare, last year, the inverted yield curve. Those things were quickly taken care of. The 10-year yield went up. This virus brought us all the way down to 0.31 basis points. Once this goes away, don't think of accelerated rate of growth for the U.S. economy or a V-shaped recovery. Just getting back to 160 just brings us down to kind of the slow and steady U.S. 10-year yield that has been here many times out here. Below 160, you start to get, headline-driven recessionary talk out there. So 160 should be the level that people should think about once all this goes away. And then after that, when growth picks up, the 10-year yield should be above 2%. But the data has to support it. The bond market will kind of get ahead of this out here. And it's not like we're a super fast economy anymore. We're just more mature now than we were earlier in our country's history. So don't think that rates are going to go up significantly. But from these levels, even 3.75% takes out the refi market, because we've taken off a lot of supply out here. So people have to be mindful of that if the virus gets worse and worse and stays worse, the 10-year yield will be at this level. Pricing will eventually catch up. But the world is going to defeat this.
Yeah.
That's kind of what the world does. Whenever we need to come together, we do this. We've handled all the other viruses in the last 2,000 years. So we can handle this, but for the next 6 months, whether it's 2 months from now, the data gets better or the news gets better, or 6 months from now, after September, if we don't have better news on this virus, this thing is something else than even I thought. So, and the 10-year yield will just basically stay right here, below 1%, even possibly go negative. But if I believe what I think is going to happen, that 6 months from now, the news will get better. The 10-year yield should be back to 160.
That means rates are going to be low. I mean, rates in the threes is incredible. Rates in the twos is unbelievable. So, that is, rates are going to be very low, it sounds like, for an extended period of time. And, it's going to be a good market for mortgage people. It
is. And, in that Housing Wire article, I talked about since 1981, we've always had a 2% plus lower mortgage rates in every new cycle. For that to happen in the next cycle, we need 1.25 to 2.25 30-year fixes. I don't think we'll get there in terms of duration like we've had in this cycle, where we've been between 3.5% to 4.5% since really 2011. But don't be shocked if when we do go into recession that the mortgage rates will be in 2% level and even break under 2%, for a very quick time. I just think the U.S. economy is more dynamic than others. We actually have the ability to create demand inflation where other countries don't. So don't think of higher mortgage rates ever.
Yeah.
That's the downtrend has been here for 4 decades. I think that's the hardest thing to convince people over the years, is that everyone's told that mortgage rates have to go higher out here, and they could go higher within the range of a cycle. But people thought 8% was too low, 6% was too low, 5% was too low. That downtrend in the bond market has been there, and so far there's been nothing else. And the thing that drives that is not the Federal Reserve or anything. It's growth and the kind of inflation growth can bring. And the world is in kind of a demographic deflationary phase where we have a lot of mature countries. We have a lot of older people now. They're kind of going to pass on. We have a younger population, but it's just basically replacement workers. So we don't have the growth levels to warrant high mortgage rates. And we're not going to have like an oil shock,
right,
like from 1973 to 1980 where oil prices went up. We just don't have the environment for higher mortgage rates. That whole theory for 4 decades has failed. So low rates, real home prices can accelerate. That would be the downside of all this. But just remember that, you have ebbs and flows. When rates go up, you create more future supply for refinances. Then eventually they come back down. That's kind of the mindset people should think.
Absolutely. Well, thank you very much, Logan. This has been extremely valuable. And anybody that's interested in following Logan, obviously you can follow him on social media. You can also follow him on Housing Wire, as he's a contributor on a regular basis there. We appreciate your time. Thank you very much.
Thank you.
Thank you.